Imagine walking into a bustling marketplace where millions of people gather every day to buy and sell pieces of the world's most successful companies. This isn't a fantasy. It's the reality of the stock market, a fascinating ecosystem where fortunes are made and lost with the click of a button. Yet for many aspiring traders, this world remains as mysterious as ancient alchemy, filled with confusing jargon and seemingly unpredictable price movements. The stock market operates on principles that are both elegantly simple and remarkably complex. At its core, it's about understanding how businesses create value, how investors evaluate that value, and how market forces constantly reshape prices. Throughout this exploration, you'll discover why successful trading isn't about predicting the future, but about understanding probabilities and managing risk. You'll learn how different trading styles can match different personalities and schedules, and perhaps most importantly, you'll understand why the most successful traders focus more on not losing money than on making spectacular gains. These insights transform trading from gambling into a disciplined craft that rewards patience, knowledge, and emotional control. Understanding stock trading fundamentals and market mechanics. Stock trading begins with a surprisingly simple concept. When you buy a share of stock, you're purchasing a tiny ownership stake in a real company. Think of it like buying a slice of pizza from a whole pie. Except this pie might be worth billions of dollars and employs thousands of people. Each share represents your proportional claim on the company's assets, earnings, and future success. If the company prospers, your slice potentially becomes more valuable. If it struggles, your investment may decline. The mechanics of how stocks function reveal the elegant logic underlying market capitalism. Companies issue stocks primarily to raise capital for growth, much like how you might ask friends to invest in your lemonade stand in exchange for a share of future profits. When a company first sells its shares to the public through an initial public offering, it's essentially saying, "We believe our business will be worth more in the future than it is today, and we're willing to share that growth with investors." This creates a fascinating dynamic where the company's success becomes directly tied to shareholder wealth. Different classes of stocks serve various investor needs and company objectives. Common stocks provide voting rights and potential dividends, making shareholders true partners in the company's governance. Preferred stocks typically offer higher dividend payments but limited voting power, appealing to income-focused investors. Some companies issue multiple classes with different voting weights, allowing founders to maintain control while still raising public capital. Understanding these distinctions helps investors choose securities that align with their goals and risk tolerance. The stock market exists because it solves a fundamental problem. How do companies access the capital they need to grow while providing investors with liquidity and fair pricing? Without public markets, brilliant entrepreneurs with groundbreaking ideas might never secure the funding needed to change the world. Simultaneously, individual investors gain access to wealth-building opportunities that were once available only to the ultra-wealthy. This democratization of capital has fueled much of the economic growth and innovation we see today. Every investment carries inherent risks that must be carefully weighed against potential rewards. Stock prices can be influenced by countless factors, from company-specific news to broad economic trends, geopolitical events, and even investor psychology. The key insight is that risk isn't something to be eliminated. It's something to be understood, measured, and managed. Successful traders develop an intuitive understanding of risk-reward relationships, learning to position size appropriately and never risk more than they can afford to lose on any single trade. Trading styles and strategic approaches. News trading capitalizes on the immediate market reactions that occur when significant information becomes public. Think of it like being at a concert where everyone suddenly hears the same song. The crowd's reaction is swift and often dramatic. News traders position themselves to profit from these rapid price movements. either by predicting the direction of the move or by using strategies that profit regardless of which way the market jumps. The key insight is understanding the difference between market expectations and actual results, as prices often move not based on whether news is good or bad, but on whether it's better or worse than anticipated. End-of-day trading offers a more measured approach that appeals to those who prefer analysis over rapid-fire decision-making. Instead of watching every price tick throughout the day, end-of-day traders focus on closing prices and daily patterns, making their trading decisions when markets are closed or nearly closed. This style eliminates much of the noise that can cloud judgment during active trading hours. It's like studying a completed painting rather than trying to guess what the artist will paint next while they're still holding the brush. Swing trading seeks to capture price movements that typically last from a few days to several weeks. Swing traders are like surfers waiting for the perfect wave. They're not interested in every small ripple, but they're ready to ride the bigger swells when they appear. This approach requires patience and the ability to hold positions through normal market fluctuations while keeping an eye on the larger directional moves. Technical analysis plays a crucial role here, as swing traders rely heavily on chart patterns, support and resistance levels, and momentum indicators to time their entries and exits. Day trading represents the most intense and time-consuming approach to market participation. Day traders complete all their transactions within a single trading session, never holding positions overnight. This style demands constant attention, quick decision-making, and strong emotional control, as the rapid pace can amplify both profits and losses. Like a skilled chess player who must think several moves ahead while the clock is ticking, successful day traders develop pattern recognition skills and lightning-fast execution abilities. However, this approach requires significant capital, advanced tools, and typically isn't suitable for beginners. Trend trading and scalping represent opposite ends of the time spectrum. Trend traders look for sustained directional movements that can last weeks or months, riding these waves for substantial gains while accepting that they'll miss the very tops and bottoms. Scalpers, conversely, make dozens or hundreds of small trades daily, seeking tiny profits that accumulate over time. Each approach requires different skills, temperaments, and risk management techniques. The choice between them often depends more on personality and lifestyle constraints than on which is objectively better. Stock market operations and exchange functions. Stock markets function as sophisticated matching engines that bring together buyers and sellers from around the world. Imagine a vast auction house where millions of items change hands every second, with prices determined by the constant interplay of supply and demand. The primary market is where companies first issue their shares, like an artist selling paintings directly from their studio. The secondary market is where these shares trade among investors afterward, similar to an art gallery where paintings change hands among collectors. Modern stock exchanges serve multiple critical functions that maintain market integrity and efficiency. They provide price discovery, ensuring that securities trade at fair market values based on available information and investor sentiment. They guarantee transaction settlement, meaning when you buy shares, you'll receive them, and when you sell shares, you'll receive payment. Exchanges also maintain orderly markets by implementing circuit breakers during extreme volatility and ensuring that all participants have equal access to information. Stock exchanges generate revenue through various channels, transforming them from simple meeting places into sophisticated financial businesses. They charge transaction fees for every trade executed on their platforms, collect listing fees from companies that want their shares traded publicly, and sell market data to traders and institutions who need real-time pricing information. Additionally, they offer advanced services like high-frequency trading infrastructure and specialized order types for institutional clients. The significance of stock markets extends far beyond individual investment gains or losses. These markets efficiently allocate capital throughout the economy, directing money toward the most promising business opportunities while allowing unsuccessful ventures to fail. They provide liquidity that makes it possible for entrepreneurs to cash out their investments and for retirees to convert their holdings into spending money. Without well-functioning stock markets, economic growth would slow dramatically, as capital would remain trapped in less productive uses. Competition among exchanges and alternative trading venues continues to evolve the market structure. Dark pools allow large institutional investors to trade without revealing their intentions to the broader market, while blockchain-based platforms promise to reduce costs and increase transparency. These innovations challenge traditional exchanges to provide better services at lower costs, ultimately benefiting all market participants through improved efficiency and reduced trading expenses. Successful trading techniques and stock selection. Choosing the right broker is like selecting the right vehicle for a long journey. The decision significantly impacts your experience and potential success. Full-service brokers provide comprehensive guidance and personalized advice, but charge higher fees for their expertise. Online discount brokers offer low-cost transactions and sophisticated tools, but leave the decision-making entirely to you. Your choice depends on your experience level, available time, and willingness to pay for professional guidance. Beginning traders often benefit from starting with full-service brokers to learn the fundamentals before transitioning to lower-cost platforms. Understanding different order types transforms you from a passive market participant into an active strategist. Market orders execute immediately at current prices, guaranteeing that your trade will complete, but not guaranteeing the exact price. Limit orders specify the maximum price you're willing to pay or minimum price you're willing to accept, giving you price control, but no guarantee that your order will execute. Stop orders become market orders when triggered by specific price levels, helping you limit losses or protect profits automatically. Stock selection requires balancing quantitative analysis with qualitative judgment. Look for companies that dominate their markets, possess strong Stock selection requires balancing quantitative analysis with qualitative judgment. Look for companies that dominate their markets, possess strong competitive advantages, and operate in industries you understand. Examine financial trends over multiple years rather than focusing on single quarters, as successful businesses typically show consistent growth in revenues and profits over time. Pay attention to dividend payments, as companies that regularly return cash to shareholders often demonstrate financial strength and management discipline. Timing your market entry involves understanding both technical and fundamental factors that influence stock prices. While it's impossible to consistently buy at the absolute bottom and sell at the absolute top, you can improve your odds by entering positions gradually rather than investing everything at once. Dollar cost averaging reduces the impact of short-term volatility, while technical analysis can help identify potential support and resistance levels for better entry and exit points. Surviving as a stock trader requires developing systems that protect you from your own psychological biases. Keep detailed records of all transactions for tax purposes and performance analysis. Ignore hot tips from unverified sources, as these often represent pump-and-dump schemes designed to separate you from your money. Build positions gradually to reduce risk, and never invest money you cannot afford to lose completely. Remember that successful trading is a marathon, not a sprint, and the goal is consistent profitability rather than spectacular gains. Risk management and portfolio protection strategies. Trading risk management encompasses all the practical steps you take to protect your capital from significant losses. Think of it as wearing a seatbelt while driving. You hope you'll never need it, but its presence allows you to travel with confidence. The fundamental principle is counterintuitive, by focusing primarily on preventing losses. Rather than maximizing gains, you create the conditions for long-term profitability. This happens because small, manageable losses preserve your capital and emotional equilibrium, allowing you to continue trading and learning from experience. Position sizing represents one of the most crucial yet overlooked aspects of risk management. Professional traders typically risk only 1 to 2% of their total capital on any single trade, ensuring that even a string of losses won't destroy their accounts. This approach might seem overly conservative, but it's what separates successful traders from those who blow up their accounts. Think of it like a casino managing its risk. They don't bet everything on a single hand, no matter how good it looks, because they understand that even high-probability events can fail.